Now I wish to take care of one sum from exercise. The exercise is from a chapter of accounting ratio. Observe the sum on the screen. The balance sheet of P.Q.R. Limited as on 31/3/2004 is as under. On asset side, you are given fixed assets, investment, stock, debtors, prepaid expense, bills receivable, cash and bank bills, preliminary expense. Preliminary expense is a fictitious asset. It is not a real asset. Notice it. Liability side, you are given equity share capital, reserves and surplus, 15% debentures, creditors, bills payable. Additionally, total sales 7,50,000. Cash sales are 1/4 of credit sales. So cash sales is 1/4 of credit sales. Means what? If credit sale is ₹4, cash sale is 1. Understand one thing. Cash sales is 1/4 of credit sales. Implies what? If credit sale is ₹4, cash sale is 1/4 of 4. That is ₹1. So 1 rupee is the cash sale. Or you can say that cash sales are 1/4 of the credit sale. The ratio of cash sales to credit sale is 1:4. So 1:4 is the ratio between cash sales and credit sales. So total sales 5. So 7,50,000 if you distribute, 7,50,000 distribute in the ratio of 1:4. So 7,50,000 into 1 by 5. 15 5s are 75. 1,50,000 is the cash sales. And 7,50,000 minus 1,50,000 cash sales, 6 lakhs is the credit sale. This is an important understanding. Gross profit, net profit before deducting debenture interest 30,000 and provision for tax 1,20,000. So before deducting debenture interest 30,000, 2 lakhs into 15% if you work out, that works out to be 30,000. Notice it. Opening stock on 1/4/2003 70,000. From the above information, calculate the following ratios. Which are the ratios we are required to work out? Gross profit ratio, net profit ratio, stock turnover, proprietary ratio, debtors ratio, takes 360 days in the year, debt equity ratio. Now let us start one by one. First, gross profit ratio. What's the formula? Gross profit upon sales into 100. This is the gross profit, this is the total sales readily available. So 1,87,500 divided by 7,50,000 into 100. It works out to be 25%. So first ratio is done. Next, net profit ratio. Formula: net profit divided by sales into 100. This is an operating profit. Now, notice this important note. Net profit means profit remaining after deducting all expenses, selling, distribution, financial, depreciation and provision for taxation. This financial expense is not deducted. Provision for taxation is not deducted. Then deduct it and find the net profit. Then work out the net profit ratio. So net profit as given 2,70,000, that is before interest and tax. Deduct interest 2 lakhs into 15%, 30,000. Deduct tax provision 1,20,000. So net profit 1,20,000 divided by sales into 100. 16% is the net profit ratio. This is an important note that you should keep in mind. Next, stock turnover ratio. Stock turnover is cost of goods sold divided by average stock. Now sales minus gross profit, you will get the cost of goods sold. I want to work out the average stock. Opening stock plus closing stock divided by 2. Opening stock 70,000. Closing stock 1,55,000. Divide 1,12,500. Now cost of sales, average stock. 5,62,500 divided by how many times? 5 times. 11 5 are 55. 5 times. So this is the stock turnover ratio. Next, proprietary ratio. Owner's fund divided by real assets. Total real assets into 100. Now I am required to work out the owner's fund, equity share capital, reserves and surplus. This preliminary expenses gets deducted because it is a fictitious asset. 6 lakhs is the owner's fund. Real assets, total assets minus 5,000, fictitious asset. So total assets 1 lakh minus 5,000 preliminary expenses. These are the real assets. Owner's fund 6 lakhs divided by 9,95,000. 60.3% is the proprietary ratio. The important point to be remembered is deduction of these preliminary expenses from the total assets to work out net real assets. And for working out the owner's fund also, you are required to deduct the preliminary expenses. That's an important point to be noticed by you. Next, debtors ratio. Debtors plus bills ratio were divided by annual credit sale into 100. Now we are required to work out the credit sales. As I told you before, I am preparing a note for that. Notice it. Suppose credit sales is 4, cash sales is 1/4 of 4 rupees. That is equal to 1. So ratio of cash sales and credit sales is 1:4. So credit sales is equal to total sales multiplied by 4/5. That works out to be 6 lakhs. Now debtors plus bills receivable 132 plus 68 divided by credit sales 6 lakhs. Number of working days to be taken, how much? 360. If you work out, you will get the average collection period. That works out to be 120 days. Average credit collection period from customers, from debtors to whom goods have been sold during the year on credit. Next, debt equity ratio. Very important note. Paper setters are expected to specify whether the debt equity ratio is to be calculated on the basis of total or long-term debts. However, when there is no specific instruction, calculation should be based on total debts. So long-term liabilities plus current liabilities means total debts. Here I am going to work out the debt equity ratio on the basis of total debts. Total debts divided by owner's fund into 100. I want to work out the total debts. Long-term debts 15% debentures plus creditors plus bills payable. This works out to be 3,95,000 total debts. Now owner's fund we have already worked out. Share capital plus reserves minus preliminary expenses. This is we have already worked out. So debt equity ratio 3,95,000 divided by 6 lakhs into 100, 65.83%. So this is how debt equity ratio is worked out. Now I have tried to explain you all this ratio, bringing important notes. I feel that you have followed all these things. Thanks to all of you.